Hey, everybody, welcome back to another beautiful day in real estate. And it is another really beautiful day in real estate. Things are looking pretty juicy as of right now. We're going to go over all that stuff here this morning. And then at the end, we're actually going to talk a little bit more about the financial system today and what you should be preparing for as we move into the end of 26 and into 27. So without further ado, interest rates as always. Interest rates haven't moved much, you guys. 6.32 on the national average for conventional, 5.88 and 5.89 for FHA and VA. I expect these to go down on Monday. I really do. And here's why. Now, the thing that we woke up to today was a massive fall off the cliff kind of movement with oil. So ever since we've seen this double top, which was pretty significantly easy to spot at 115, we had a lower high and it fell down, tried to find some support at 88 and fell off a cliff into 82 today. So from all-time highs, you guys, we are at right now about a 30% drop. That's a pretty big significant move, and you want to know why? Because we found out that the Iran is now opening the Strait of Hormuz for the remainder of the ceasefire, which ends in 4 days. Now, this is good news, right? Because we've seen a couple of things that are a little highly unusual. We'll say that at the best, right? So markets opened 6 minutes ago, and the S&P 500 is at all-time highs. All-time highs, 701. I think we're expecting to see 722 on the high end in the next few days. But this is actually kind of insane. Okay, we've seen trillions of dollars come back into the market over the last couple weeks. As if, and like the crazy thing that we have to be paying attention to is that, let's see, where did the war start? War started right here on the 28th. We fell off a cliff. Let's pull this up so you guys can see. So we fell off a cliff right around here at the 28th. All the way down, and then we rebounded, and now we're back up. So let's talk about this. So we have a support level right around here. Man, I don't really know. That wasn't much to bounce off of. So it had to have been a lot more news-driven than technical-driven, which is what it is. But, dude, the S&P took a rip. Ever since we've seen our bottom all the way to the top, we've seen an 11% increase. Dude, that's actually a big move in a month. Holy shit. Okay, a month and a half, but still. No, it was about a month. I lied. It was about a month. All right, anyways. 2 weeks? Did I read that wrong? 2 weeks? So seriously, it's been 2 weeks since we've seen the bottom, and we're already up 11% in the S&P. That's a huge move. Big move. Now, unless we get some major volume today, this right here tells me we've ran out of juice, and we're probably going to see a rebound somewhere along the lines. We're overbought on stochastics heavily. The RSI is getting to its peak above the above 75, closer to the 77. Anyhow, this points out a couple of things for me. The market is pricing in an optimism that the ceasefire is actually going to end the war in Iran. Personally, I'm not 100% convinced just yet. And that's okay. I don't need to be 100% convinced. All I need to do is see the data, which the data is showing me right now that we are seeing a potential move towards a blow-off top. Now, those of you that don't know what that means, that is like the peak of a bull market, right? That is when everything just tears. Those of you that jumped on, we'll say you bought Bitcoin, right? It was like the last 3 weeks in the last major bull run or 3 months where it just went up. Everybody thought it was not going to come back down, or no, everybody expected it not to come back down. You had price predictions at 150,000 for a Bitcoin, 200, 300,000. Everybody said it was going to $1 million. That's when the markets are extremely over leveraged, 1, and 2, that's where most people lose their money. The market goes up and up and up and up and up and up, and they just think that they're invincible. And I'll tell you right now, most of you are going to lose your money in that time. If this really becomes a blow off top, if they end the war, turn the money printers on, put interest rates down, pull interest rates back with the new Kevin Warsh, if he gets appointed, which they're talking about not appointing him, which is a whole nother conversation. But right away, okay, we talked about this yesterday. Let's continue on. I'm going to keep my rants kind of short today if I can. So we bounced off of 4.24, went above, and then we started breaking down, right? So we saw a little bit of volume up. I kind of expected us to maybe continue, but this morning, obviously with good news, everything went down. So the stochastic couldn't break above 20 over here. I think we're 18 to 20-ish. I'm sorry, 18 to 20. When it can't break below this bottom, it's not a good looking sign, which is good for us, right? That means people are buying 10-year bonds. 10-year bonds pushing those down, pushes interest rates down, which makes real estate more affordable for you, right? So this is good news. I'm not 100% convinced this is going to stay forever, but this is a good news. You guys, we're moving into the spring market. We're after Easter. Granted, we got a little bit of snow. That's going to go away. But people are getting ready to buy houses. I have 5 under contract this week. It was a nice, fun week. All right. People are coming out of the woodwork and they're ready to buy. They've been sitting for a long time. They're making the decision. They're jumping in. They're doing the thing, right? So here's what we need to be paying attention to. When we see the S&P ripping like this, again, there's no reason that this should be at all-time highs. We haven't seen an actual end to the war. We haven't seen a ceasefire deal that's actually went significantly well. So, and the rule of thumb when it comes to trading is this gap is going to have to be covered. It's going to have to be covered. You don't see a gap that goes, Jesus, what a day, man. So that was Tuesday to Wednesday. Tuesday to Wednesday, we went from 659 to an open at 671. Dude, that's nuts. Okay. So that the trading rule of thumb, that has to come back down, okay? Trading rule, it has to come back down. When will it? I don't know, but it's going to have to fill that gap. It will. So I got to say, things are looking good right out the gate today. I was listening to some Ricky Carruth, and he was talking about getting ready for the market to rip. I love Ricky Carruth. The dude's got more optimism than any person in this market. Now, I will say this. Realtors, you are in the hardest market to be selling and buying real estate right now. Every single deal, every single one takes strategy, takes conversations, negotiating. It's been a very, very hard market for the first time in almost 20 years. Ever since like 2008, we're going to reference 2008 because everybody loves it. It's our favorite one. This is the market that we're in right now. Everybody's talking about, I shouldn't say everybody, but a lot of people are, and some people have commented on my videos and they're like, the market's going to crash. Real estate's slimming. You obviously don't know what you're talking about. And, that's okay. Maybe I don't. I really don't care, to be honest with you. I'm trying to figure out my best opinion of the market. And so far, we've been pretty good with it. So I'm going to stick with that. But right now, again, I'm going to reference 2008 to 2026. 2008, there was 4.1 million homes on the MLS. This year, we have 1.7. There was 2.87 foreclosures at the peak of 2000 and I believe 9. There is 340,000 right now on average, right? Or on the numbers that we're seeing, right? We had 11 months of inventory on average, on the national average during 2008. Now we have 3.8. The market is different. Yes, affordability is playing a key, but here's the thing. Even in North Dakota, right now, a house that hits the market at the right price, which again, I keep encouraging you realtors to understand what it means to understand having the right price on the market. Right now, homes are listing at the right price in the spring market and they're getting multiple offers. My client, we're going to look at a house today. It's been on the market for 2 days. Yesterday, we couldn't even get in for showings because it was literally that packed, okay? The market's not going south for real estate. The market isn't looking good on the credit cards, auto loans, defaults. That's where you're seeing issues. That's where the cracks are coming. And here's the problem. The private credit market came and was established right after 2008. And they turned it into a similar position than 2008, but removing the risk from real estate and putting it into paper asset equity. So what that means is, now, first off, before we get too far into that, this is what we woke up to today. Breaking news. U.S. oil prices crashed to $83 a barrel as Iran officially reopens the Strait of Hormuz for the remainder of the ceasefire. Now, yesterday I was reading articles that Europe was just 6 weeks away from having no fuel, which is going to affect planes and cancellations, blah, blah, blah. I don't care how much countries hate each other. They are not going to let the money from public transport like a jet, they're not going to let that stop. There just aren't. They're going to open things up so they can continue to see money flow through because not everybody, but companies that make decisions, the big names out there, the ones that have B's in front of their names and T's in front of their names, are the ones that are making T's, I mean billions and trillions of dollars behind them. Those people own those companies, and they are not going to allow their companies to stop making money. It's just not going to happen. So when I read that yesterday, I anticipated we're going to see something in a positive note that's going to start pushing prices and moving product once again. You guys, in my opinion, this is all a very unfortunate staged kind of situation where I feel like this was blown way out of proportion on many media sites. and on both spectrums. Like literally, if you read the news from Iran versus the United States, it's two different stories completely always, and that's super unfortunate because people's lives are taking at risk on this. But again, it's not my world, so I'm going to keep where I understand, and I'm going to start paying attention to the markets, because right now I still think we might be moving to a blow off top into the midterm elections. And to me, again, we have to think about logical. Logical makes sense, because if we move into the midterms and we actually see a blow off top, do you know what that means? That means that people are going to be voting Republican in right, because the markets are going to be going after it. The last 6 months, which we're kind of in that 6 months, I mean, November's the elections, but we're about 6.5 months away from elections right now. So here's what I'm expecting in the summer. I am expecting, with Kevin Warsh getting put into office, that they're going to be pushing down interest rates as much as they can. They're going to be putting liquidity into the markets, and we're going to see a blow off top, because they need to show positive. After the last year where we've seen a lot of bumpy roads, they have to, if they want to win. Again, this is saying, if again, I'm not right versus left. I don't give a rat's ass, but I'm going to tell you what I know. When you're in government and you're trying to be the dominant party, you're going to do whatever you can to stay above it. And right now, to me, it seems the Republicans have the upper hand, because they have the upper hand in Congress, they have the upper hand in Senate, and obviously you have a Republican president. So they're going to be focusing on how can we push up the market and make people feel good, so when the election comes around, they vote more red, right? That's what you need to pay attention to. You can listen to every headline across the spectrum, but I can guarantee you that they're going to do everything in their power to prevent seeing a market crash before the midterm elections. After, different story. But before, they're going to be pushing as much as they possibly can to make sure the markets stay elevated, right? But so here's what we need to be paying attention to. Let's talk about that for just a second, okay? I'm going to move one story around here real quick, and we're going to do this one first. So this was a big one. So this Kristen Shaughnessy, she's popped up a couple of times in my stuff, and she's starting to become more and more popular in my news feed. But here, this is a big one to pay attention to. Banks finally do real due diligence on private credit. Some big banks are raising interest rates for the leverage they provide, and they're also making specific loans posted as collateral. Think of that for just a second. Behind the scenes, that's prompting private credit fund managers to swap out holdings, and I highlighted that for a reason. From the pools as banks including J.P. Morgan Chase, Goldman Sachs, and Barclays exercise their right to write down individual assets according to people involved in the talks. The stakes are high enough that the bank executives are getting directly involved and adjusting interest rates they charge for leverage and tightening collateral terms, some of the people said. Because banks don't have all the same rights to challenge assets, some may end up better protected than their rivals if private credit defaults begin to rise. The managers to swap out holdings and collateral. Whoop. What did they do in 2008? Private swaps. They swapped out collateral. There's more to it than that, but those two things, that sent a trigger in my brain to say, the private credit market is still not anywhere near good right now. Okay, private market firms face more pressure as bank swaps collateral. That headline right there should be putting you in a time of oofda. I don't think, and I'm maybe overly optimistic today, but I think that again, this is from my mentor, Coach JV. Shout out to Coach JV, by the way. You're an awesome person. We appreciate you. We love everything you do. But be careful. This makes no sense. Super overpriced. Know the game. So those of you who don't know, go follow Coach JV. He is phenomenal at macroeconomics. I listen to his stuff almost every single day. He's a phenomenal person to learn from. But anyhow, so it says S&P 500 futures surged to new record highs with reports of second round of U.S.-Iran peace talks. This puts the index 12% higher since May 30th lower. 12%, we talked about that. Massive short squeeze underway. So what is happening again is the market was so bearish for so long that there was almost over leveraged down in the negative and there was no pressure up. Well, the market shifted significantly, and when you have more calls than you have puts, then the market pushes up, right? So it's like it's a leverage thing, right? So like let's look at Bitcoin for a sec. If you have more selling pressure on Bitcoin, the price goes lower. If you have higher buyer pressure, then the market goes up, right? So same concept. There's significantly more buying pressure right now. And when this happens, it typically means that a majority of the retail investors are pushing as much money as they can in. And this is where most retail investors get caught holding a bag. And that's why JV said, know the game. Know this game, because what happens is most of you are going to come in and you're going to gamble. You're not going to invest. You're going to gamble with the sole anticipation that the market's going to continue to go up. And it's not going to go up. It's going to hit a top. You're going to think, oh, this is just a correction. This is no big deal. I'm going to double down. And you're going to buy more. And the person who's been buying for the last 5 years is going to sell, and you're going to buy their bag, and then it's going to keep going down and down and down and down. And that's where we're at. That's why we're getting to that blow off top. If we start to see the next 3 months, I mean, we could be in a blow off top now. I mean, we've seen the S&P rip pretty significantly since March 30th. That bounce could just have been the blow off, beginning of the blow off top. And we hit the bottom, and now we're just moving upwards. Okay. And again, this why I think we're in a blow off top. Next conversation. Institutions are loading up on call options at the fastest pace ever recorded. So this goes all the way back to 2005, so really not that far back. But anyhow, we're seeing a significant amount of calls. So what does that mean? That means if the market goes up, they make money. If institutions are doing this, institutions are all anticipating we're going to see a higher market. Basically, what this stuff does is if you buy at $10, right, and the price goes up, you make money. But if the price goes down, you have a limit where you're basically going to lose only what the premium is. You're not going to lose negative equity, right? So I'm not a big trader, so I'm not going to try and explain all this stuff. But this is something that we need to be paying attention to, right? Because what they're going to do if they're going to crash the market is they're going to push it up significantly high. They're going to give you the bag. You're going to ride the whole wave down, and you're going to be in this depression state because that's how bull markets work, okay? Next, okay, next tick in the last video we're going to talk about, and then we're going to talk about article. Why is no one talking about this? Former Treasury Secretary Henry Paulson is warning about a U.S. debt crisis. He's not a regular guy. Paulson served as U.S. Treasury Secretary during 2008 crisis, and he senses when it's coming. Recently, he's urged U.S. authorities to develop a backup plan to prevent potential collapse of the debt crisis. He said that a breakdown in the $39 trillion debt market for U.S. government debt would differ from the financial crises he managed. Okay. We've been talking about this. Private credit is the big issue right now. The debt is a big issue right now. We're at $39 trillion in debt currently. $39 trillion and significantly rising every single day, right? However, the U.S. public debt crisis, when you're trying to issue treasuries and the Fed is the only buyer and yields are going up, that's a dangerous thing. So they're trying to issue more bonds. Nobody's buying the bonds, or now they're, kind of not nearly as much as they have been. If you've paid attention, China, Japan, other countries have been selling U.S. bonds, which is not a good sign, right? That means that they're not confident in the U.S. dollar anymore. Okay, this is because rising yields make the debt servicing even harder and add more cost burden. So any investor who's in real estate right now at 6 and 7% interest rates, they're not buying very many rental properties unless they're a cash buyer. Why? Because you're not cash flowing. The house I'm in currently, we're going to be building a new one. I'm trying to pull a HELOC on this and potentially keep it. My interest rate is low enough. It's in the 3s. I can still cash flow this property pretty significantly if I so choose to, right? That's where investors bought a bunch in real estate in 2020, and commercial arm loans are coming into effect. That's another thing we should be talking about, but we'll hold off on that for just a second. But he didn't mention a timeline for the crisis, but urged U.S. authorities to prepare before it gets out of control. This is why I have been cautious of markets in 2026, and a lot of these things haven't priced out yet. So we haven't seen this yet, but there's a lot of talks about a crisis coming. And the thing that most people are not going to see is the crisis comes when most people don't anticipate it, and again, I think that's where that blow off top is going to come into play. There is warning signs that we are over leveraged on car loans. Credit card debt is sickly high right now. It's insane right now. You have people who, I said this in one of my videos the other day, 7 to 8 year mortgages or loans on their cars. I know people that are paying $1,200 a month for their car payment. $1,200, dude. I pay $1,700 for my entire mortgage on my house currently, and you're paying $1,200 a month for a car. That's insane to me. Okay, we have way over leveraged. Now you have the private credit market, which is starting to crack, right? And again, as I've said before, the bag holders are not the bank in that situation. You are. They invested that money into your 401k. So when those do come collapsing backwards, you're the person that's holding the bag. And unfortunately, there's going to be a ton of people when that happens that are going to not be able to retire because of that. And that has happened quite a few times over history in the most recent 10, 20 years, is that people were expecting to retire and they can't because they can't pull their money out to a certain age. But by the time they get to that certain age, the market crashes. That is super frustrating. You are at the mercy of the market. It's why I don't buy a 401k. It's why I don't have, my wife has a Roth IRA, and that's a different story. But that's why I leverage my money elsewhere, because I don't want to be caught holding the bag when the market does crash. If anything, I want to have more cash flow and more cash built up, which I'm building right now is a lot of cash, because when the market does come down, I will be buying, because that's the difference between most investors. They buy and invest every single week, and they have no plan on what they're going to do. I still buy every week in certain assets because I know what I'm buying into. I'm confident. I love what I'm buying into. But when stuff like this pops up, and it's not really a pop-up, this has been going on forever, and now we're starting to see the reverberation effects, and I think they're going to push more money into the economy before it crashes. I think they have to, again, to win those midterms this fall. So all of that being said, we haven't even talked about the real estate side, so we're going to make it a very quick one, and then we're going to jump back in. So somebody did tell me about, on one of my videos, I said that things are getting more negative in the real estate market, and here's what people are seeing, and they think it's across the entire United States. Countries, states like Florida. Over 1,000 houses in Florida now have the word short sale in front of the listing description. Most are listed at a loss from previous sale, some at $100,000 discount. Real distress is starting to show up. According to Anton, foreclosures in Florida went up 43% in Q1 of 2026. If you want a discount, now's the time. Oopsies. This is why it's so important, right, you guys, because the market is very bad in some places. And that's the real estate market that's going down. But again, if we're factoring in Minnesota, which is still pretty solid, I would say North Dakota is a lot better. But North Dakota, I still have only 1.8 months of inventory. I have less than 2 months of inventory right now. Houses are selling with multiple offers. Houses are selling quickly, significantly quickly, if they're priced correctly. So the market is just recouping and regressing back to where it initially was before we saw the blow-off top in real estate. That's all it is. And everybody becomes over leveraged at a certain point. And Florida, you could tell Florida was peaked because there was 25,000 Airbnbs between or around Orlando, Kissimmee, and a few other places. 25,000 active Airbnbs. I don't care how busy Florida gets. That is way too many for that market. Way too many for any freaking market. But that's the point I'm getting at. The market isn't crashing in real estate all over, but there are places where you're seeing a reverberation effect of being over leveraged and overpriced. All that being said, get ready, because I think we're in for a really interesting next few months, and I'd love to go on the journey with you. So if you made it this far, make sure to like and subscribe, and we'll keep bringing you more content as it progresses. Have a great day.